Welcome to the Three Questions webcast series. I'm Wayne Baxter, Executive Director with One Capital Management. At One Capital Management, we develop and implement strategies that enable our clients to grow, protect, and ultimately distribute their wealth. And we do that by offering investment wealth management services. Thank you for taking time to check us out. My clients are often referred to as cross-border clients. Now, why is that? Well, it's because they're either U.S. or Canadian residents who wish to or need to invest in U.S. and or Canadian dollar-denominated securities like stocks, bonds, and ETFs. Our process for advising our clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives. And needless to say, that will include an in-depth review of their investment strategies. On this webcast, we'll be reviewing the 3 questions cross-border investors should ask about investing when there's a possibility of a recession. Joining me today is Lance Messervy. Lance is a director and senior portfolio manager here at One Capital Management. And Lance leads One Capital's private client portfolio management team. He's responsible for the investment decisions and active daily management of One Capital's globally diversified portfolios. In addition, Lance also directs the firm's ETF research efforts. And finally, Lance is a member of One Capital's investment committee. Lance, thank you very much for making time to join us today. I really appreciate it. I know you got a very busy schedule, so I really appreciate it.
Absolutely. I'm happy to be here, Wayne. Thanks.
Great. Before we get started in our 3 questions that we're going to discuss today, perhaps you could sort of fill our audience in a little bit about the role that One Capital Management's Investment Advisory Committee plays in terms of developing our clients' portfolios for both our U.S. and Canadian-based investors.
Yeah, so the investment committee, I mean, that's really central to our investment process. And that's basically, consists of 10 investment committee members and with, I'd say, probably 100 plus years of aggregated experience. I mean, there's quite a few experienced members on that committee. And it really helps us really find the best in class investments. From a real high level, what I would say is, we have our team of analysts and our investment committee member team as well, who are out there looking for opportunities to find undervalued stocks and so forth, as well as asset classes in which we want to invest in. And we bring all that knowledge capital into the investment committee to try and identify what is the best in class from an investment standpoint. And then we bring that into the portfolio and establish that portfolio construction.
All right, perfect. And that is essential to getting a properly developed portfolio for both of these clients, as this role that this committee plays. So we should really get into our 3 questions so we can just really talk. And I guess what really compelled this discussion was a discussion that you and I had a while back about all this discussion about there being possibly a recession.
Yeah.
So what we're going to really talk about right now is the 3 questions that, and I think really this applies to whether you're investing in the United States or Canada. We're not really want to focus on one country or another, but for cross-border investors, what they should be asking about when there is a possibility of a recession. How do I invest? And I think the obvious first question that we hear a lot of times when you're going into situations like this is, should I hold on to my cash?
Right. So that's a great question. I mean, what I would say is when you look at a scenario, kind of what we face right now, but let's just say in general, right, where there's potential recession on the horizon, it can be a scary time. I mean, nobody wants to invest in a market that they feel is going to go down. And so that's a great question. What I would say on, along those lines is you never really can time the market. You never really know until after the recession has already started that you're actually in a recession. And so to really try and say, oh, I'm going to wait until the bottom, or I'm going to, wait till we're out of the recession to start investing. The problem there is you probably already missed the turn, and then you're missing your upside. The biggest thing you really want to do, I would say, is and this was partly, from an advisor's perspective too, right, Wayne, and we look at it the same way from an investment standpoint, and that is, you want to make sure you have cash on hand that you need for emergencies and for your monthly expenses, right? So, I mean, from an investment standpoint too, because we don't want you take money out of the portfolio when prices are at a lower point, right? When they had recessed because of a recession, what we would say is you make sure that from an emergency standpoint, you have cash on hand for 3
You
to
have
6 months.
liquidity.
That's right. So that you don't have to touch the investment horizon, or touch the investments when there's some form of a pullback in the markets.
And that applies not just to the client, but for you as well. You want to have some liquidity in the portfolio, so you have some dry powder to put to work.
Absolutely. I mean, and really, when you look at it, when people say, "Hey, should I hold on to my cash?" What I would say is it's for really a long-term focus on the investment time horizon, right? It depends. If your investment time horizon is longer, you should have no concern about starting to put your money to work, even if you feel like it might be going down. I mean, when we look at it right now, peak to trough, we've gone down about 24% overall in the markets. And so, I mean, we're definitely feeling like we're nearing a bottom. No one can call that. And I wouldn't be on this call with you right now, Wayne, trying to call that. But what I would say is we're closer to a bottom now than we were 6 months ago. And what you don't want to do is you don't want to keep your money out of the market and miss the rally, because the rally will be quicker.
I was just thinking, and this, I guess I'm segueing into question number 2. And I was just thinking about a discussion I had with a good friend of mine, may actually be listening in from Halifax, Nova Scotia, is a good friend of mine and a bit of a mentor of mine. And he said, the best advice he ever got was from one of his mentors. He said, you'll never go wrong investing in a balanced portfolio. And this is from back in the 1990s. Okay. Mm-hmm. This segues perfectly into our second question, which obviously is, does it make sense to invest in a balanced portfolio going into a recession?
Right. Yeah. So to answer that question, I would say absolutely. Balanced portfolio is going to be a well, balanced from a risk reward standpoint. So, but I would want to put a framework around it and say, a balanced portfolio can be a balanced portfolio based on the risk tolerance of the client, right? Let's say a balanced portfolio includes equities and fixed income. Yes. That would be a balanced portfolio, right? It's not going to be your traditional 60-40 is the only thing that's a balanced portfolio. You could have an 80-20, or you could have a 40-60, and it's going to be,
or 70-30 if you want to be.
Yeah. That's right. Because the client does have risk tolerances in which some need, can't take as much risk. And so they may not hold as much stocks, right? As much equity in that portfolio. But what I would say is absolutely, especially now, a balanced portfolio is starting to come back into play. The last few years, balanced portfolio, they tended to struggle because you weren't getting much total return out of your fixed income, because you weren't getting much carry because yields were so low. But now we're actually seeing, as we, as we teeter upon recession, and there's a lot of recession talks, we're seeing rates go up because they're trying to combat inflation. And so the rates going up is actually helping those investors that have balanced portfolios, that have some fixed income, that can gain, incremental yield off having higher rates that they're receiving for their fixed income, a higher return on the fixed income side. So definitely, I think today and going forward, a balanced portfolio absolutely makes sense. And it provides a ballast in the portfolio, right? The fixed income now provides a ballast where before you weren't getting the same benefit. When the stock market pulls back, your fixed income can rally a little bit, and it allows you to use your discipline as or us as an investment manager allows us to keep our discipline and be able to trim off some of those fixed income bonds that have, stayed somewhat strong in the market, and reinvest those proceeds into the undervalued equities. So,
what I find really interesting about your comments about balanced portfolios is, I think a lot of the public today, and thanks to what they get to read or hear in the media, is they think a balanced portfolio default is a 60-40 portfolio. Mm-hmm. What I found rather interesting is that a balanced portfolio could be a portfolio that has 40% equities or even 80% equities. In your view, can be distinctively referred to as a balanced portfolio. I think that's educational and informative for our clients to understand that it doesn't only mean a 60% equity, 40% fixed income allocation.
Right. Yeah, I think you change your skew level on a risk tolerance, but it's still a balanced portfolio to the perspective of you have equity and fixed income in the portfolio.
I think the key thing there, though, and we'll get to a little bit in a bit, is sticking to your knitting and not try to market time. I know you're on a pretty tight schedule here, Lance, so we'll try to get to this third and last question, and that is, what do I do if the market goes down further after I've invested my money?
That's a great question, and it's one that no investor wants to have to face, right? But we all will in our investment, in our investment career or our time as an investor, right?
It's inevitable.
It's inevitable. We're going to face it
multiple times.
That's right. So really, I mean, twofold. As an investment professional, I look at that and I say, I look at pullbacks as opportunities to be able to buy undervalued investments, right? So if I see a pullback, I find comfort in being able to look at those and analyze those and say, hey, these ones I want to buy because they're inexpensive. Now, first, call it a retail client or a investor that's investing their capital, right? Not a professional manager that's managing somebody else's money. Definitely, there's an emotional component to it, right?
Absolutely, 100%.
And you don't like to lose money, even if you feel like you're able to gain it back. What I would really say is there's kind of three keys to think about there. One's going to be your risk tolerance before you go into the investments, right? How much are you able to tolerate when the market does, go into, say, a bear market or a potential recession, and you get a 10% pullback? Can you physically, emotionally tolerate, the movements? So you really want to, know that going in, so that when you do get those pullbacks, you don't act emotionally, right? The second thing I would say is you want a diversified portfolio. You don't want to have all your eggs in one basket. You want to basically create a portfolio similar to what we're talking about. Like, part of it's going to be a balanced portfolio where you have some equity, some fixed income. You have assets that are in large cap, small cap, mid cap, different asset classes. And we, as well as investment managers, we manage portfolios that are globally diversified. So we diversify as well across geographical borders. And so really what you get there is we put together a portfolio that has a minimized correlation across the portfolio, so that it's the best risk-adjusted return we can build and construct within that portfolio context. And then the last thing I would say is going to just really be, you have to be, a long-term focused, right? The markets, the economies, if we go into a recession, or we've been in recessions historically in the past as well, they recover, right? We saw in 2008, honestly, it was a bad time in the markets. Everybody that was invested at that point thought it was over. And what did we see? We hit a bottom in 2009, and it started to rally back, after that point, right? That was the bottom. You couldn't see it ahead of time. You could see it historically. We saw that was the point. And then since then, right, it took a little bit of time, but we got back all the returns that were lost in that tumultuous time of 2008 and superseded that and went past, those losses and had significant gains as well. So what I would say is you really want to have that long-term investment focus, so that the short-term movements in the market, even if you get a bear market or you get a correction or you get a recession, that that if you don't need the cash, you're going to be able to ride it out and be fine on the other side, right? That's one thing we have seen historically, is markets and the economy recover, right?
Always. And I well said, like, bravo, well said, Lance. The role that we play, you as a portfolio manager, me, and basically face-to-face working with clients, there's some basic general principles. And again, you did a great overview from your point of view. What I would also add to this is that when it comes to investing, it's never the wrong time to do the right thing. Number one. And that leads to the second rule of thumb, which is that market timing is a very risky strategy. Trying to time the market, trying to say, I'm going to wait for the markets to get here, right? We all know that, and I guess it's been proven many years ago that, there's very few days during the year that you actually see markets really provide excellent returns. You have to remain fully invested.
Mm-hmm.
And I think the third one, and I've probably said this before and I'll say it again, is that you have to have a plan and stick with it. People who change their strategies because of what they see on TV or hear on the radio or read, and say, well, the world situation is changing, so I'm changing my investment strategy. That is a very tricky approach to take. If your financial situation changes, if your income status changes, if your work situation changes, or whatever the case may be, that could make sense. You may want to reevaluate your situation. But being influenced by world events and changing your investment strategy, that's we all know how that ends up, and it doesn't end up very well sometimes. So,
yep.
Lance, thank you for making time again. I know you're on a tight schedule today, so I really appreciate you making time for me. I hope we can do this one at least one more time, if not more often, down the road.
Absolutely. Thanks again, Wayne. I appreciate you involving me.
Thanks a lot. Thanks a lot, Lance. That's Lance Messervy with One Capital Management. I look forward to bringing you the 3 Questions webcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And to receive a notification of when our latest webcast has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you and see you soon.